having a failed startup is a badge of honor.
Welcome to NY Seed Round, the podcast for curious startup founders.
So I don't want to be the one to tell them this has the potential to be $1 billion company or it will be. I want to hear in their words what their goals are for success.
In each episode, I dive deep into the learnings and mistakes made by the world-class investors and operators who have helped make the New York City tech ecosystem what it is today.
What were activities that you felt have an outsized impact on the founders that you're supporting?
In this episode, I speak with Ben Zises. He's the general partner and founder of SuperAngel.Fund. SuperAngel is an early-stage fund with notable investments in companies like Quip and Caraway. In his personal blog, which I highly recommend every founder and investor checks out if you haven't already, he writes an essay called How I Got Here. I wanted to dig a little bit deeper into the essay. Things like the ins and outs of starting a company as a non-technical founder, getting to a yes from an investor in a sea of no's, and the small and big things that angel investors can do to add more value to their portfolio companies.
Justin, thrilled to be here. Thank you for inviting me in.
We're going to go into this essay that I found really fascinating that you wrote in your Super Angel blog. But first, could you give, for those listening, your sort of 2-minute, 3-minute history and how you got here today?
Absolutely. Happy to do so. So I actually grew up here in New York City, was an entrepreneur very early in my career, had a high school business, went off to college and started a student business. I guess one of my first jobs coming back to New York City was doing store leasing on behalf of owners of buildings who had empty retail space, and they would hire me to find tenants to rent their storefronts. Mm-hmm. And I couldn't understand why there wasn't a platform to sort of market these properties on the internet. You know, you see signs in windows, store for rent, but with retail space, you know, unless you're walking by the space, you might not know that it's available, and you could be a tenant, you know, in another part of town or another city. So I decided to start a prop tech company pretty early in my career based on that experience called retailmls.com. Similar in lots of ways to StreetEasy or Zillow if you're looking for a home or apartment, but this was for retail space. And so pretty early in my career, started this prop tech software company, went out, raised money from, you know, angels and VCs, and got really the whole sort of founder journey and went through that startup experience, which kind of exposed me to angel venture capital. And that experience sort of ran its course, and I fell into angel investing, 10 years ago now, in 2014. And I've been doing it, basically as often as I can. Obviously did it for 6 years sort of as a hobbyist, as a lot of people do start that way. And then I decided I wanted to do it full-time professionally 4 years ago and launched my fund, SuperAngel.Fund.
It's amazing. Yeah, in an essay that you wrote, it's titled How I Got Here.
Yep.
We'll go through several aspects I found fascinating. But number one, you talk about angels needing to have a sort of above average risk tolerance. So it made me think, like, for those that are potentially considering getting into angel investing, what are the qualities that they should evaluate themselves as having to be a good fit for it? And who are those that should maybe stay away from it?
Yeah, I really do think angel investing, should be a part of anyone's portfolio. And what's interesting is people do it for so many different reasons. So I think at the very least, it's a great financial diversification play. So I think, if you had $100 to invest, or 100,000 or $1 million, I think reasonable people would agree it's a smart diversification play to put, anywhere from 1 to 5 to maybe 10% of your investable assets into sort of the venture capital angel allocation. Certainly having, a slightly larger risk tolerance would maybe just mean you gravitate a little bit more of a percentage towards the high risk, high return opportunities that angel investing kind of can yield. But I absolutely do believe that there's a role for sort of, again, it's a subset of private equity, sort of venture capital, and then sort of angel investing, maybe just being like even earlier stage companies. But I think the benefits of angel investing, far exceed and often are more, people do it more so for other reasons beyond just the financial piece. So I find it really interesting, people angel invest for information, education, access, network, and then one of the biggest reasons, which is fun.
Yeah.
It's so much fun and rewarding. People do it to support friends and family, and just to see things happen in the world that wouldn't exist if not for, someone taking a chance really early on a woman or a man with an idea, or anyone for that matter, who has a vision. And I think those are some of the great things about angel investing, and why it kind of makes sense for everyone.
Makes sense. My next question is more about, as the part of the essay where you talk about your experience as a founder. I'm sure that lends a lot of credibility to you and the ability to like empathize with folks that you're investing in. But you are very honest about a startup venture that didn't necessarily work out how you had envisioned. How did you recover from that? What were the steps? Because a lot of founders go through that.
No question, kind of having a failed startup is a badge of honor in some respects. And that's part of one thing people love about sort of the venture capital ecosystem, even in this country as compared to other places, you can get past a failure. And I think it's just kind of widely known that most successful founders had one or many failures before they reached their successful company. So going through a founder journey that has lots of ups and then eventually kind of doesn't reach the potential that you sort of aspire to achieve going in, it's very hard to deal with. I think it makes anyone kind of question what they're doing and what went wrong and what they could have done differently. And so for me, it was no question very difficult to get through. I spent 4 years. I put my blood, sweat, and tears into my own startup. I took money from my closest friends and family. I think there's nothing wrong with really feeling that kind of pain. Yeah. And I think the key is, if you don't go forwards, you're moving backwards, and you can't change the past. And so I think the key is really taking those learnings and, making sure you don't make those same mistakes again, learning from the mistakes. But then, eventually you got to just get up, move forward, and move on to the next thing. So I actually feel fortunate that I got my failure out of the way early in my career because, again, those are learnings, and it ended up leading me to kind of what I do today. Yeah. Had I not gone through that failure and experience as a startup founder, it's likely I would not have been exposed to sort of the whole ecosystem of venture and angel investing, and maybe wouldn't be where I am today. So it might be a short-term sort of financial loss, but if you stick with it and you maintain, you keep a lot of the learnings, and you take those experiences to whatever you do next, there's a higher likelihood of success in whatever you end up doing next.
That makes sense. On the point about mistakes, like for first-time founders who are listening to this, like what's your biggest piece of tactical advice? What mistakes should they try to avoid?
Great question. I love actually answering this because, that's just one of the benefits of anyone who has experience is being able to kind of, share that with someone else and save them from making those same mistakes. So very specifically, a few mistakes that I made in my startup was overbuilding the product and trying to cram every feature into the software that my $10 billion public company competitor was offering to their customers. And I just think anyone who's built a software company knows anytime you write a line of code, it needs to be iterated, it needs to be supported, it needs to be improved on. And so we ended up just with way too many products to maintain, sort of lack of focus, a code base that was maybe 1 million lines of code. And this was going back, 10 years. And so there weren't as many off-the-shelf pre-built sort of platforms and to use. So everything was custom developed. So I would say, just like the cadence of when you release products, making sure you're successful with the products you do have in your business. The features that you do have before you just tack on new ones is crucial. Something else is get to revenue sooner and quickly as soon as you can. So we, with my company, Retail MLS, we basically invested $2 million before we were generating substantial revenue. And I think, that period of time, 2 million was maybe, inflation adjusted back then.
Well, things were more expensive too.
Yeah. Well, I'm saying, that's a lot of money.
Yeah.
And, we only started turning on the revenue monetization sort of at the tail end of when we sort of, ended up getting to the end of the line with the cash that we had raised. And so, we needed to raise more money, and we were in a position where we didn't yet have sufficient revenue to kind of justify another round of financing. And so I think, starting with sales sooner than later, a lot of people would say even like find a customer before you even build the product or solution. to kind of de-risk the business. So I think that's another really valuable lesson, is get to revenue and, of course, if you can, profitability as soon as you can in the life cycle of the business. And then just the third thing is I was building a software company as a non-technical founder, and that just doesn't make sense. I had brought on a CTO and other engineers and developers, but at the end of the day, if you're building a software company, you really need someone, I think, sort of on the C-suite, the founding team, with the technical sort of chops.
So you're a solo founder.
Non-technical founder building a software company, relying on non-founder sort of engineers to kind of build my vision, and that was tough.
That makes sense. Another lesson you bring up, and I'm going to quote you here in the essay, and we'll link the essay below for those to check out. But I quote, "I heard no what felt like 10,000 times before eventually raising $2 million from 30 angel investors and one early stage seed fund." First, what were the top reasons from the founder seat that you feel the yeses were a yes? And then we can go from there.
I always love to say the more no's that you hear, the more yeses you will hear, because fundraising is so often a numbers game. Unless you've built and sold a successful startup in the past and made money for a given investor group, first-time founders often, they're not going to be given the benefit of the doubt that they can sort of turn an investment into a successful 10x, 100x. And so the truth is, fundraising is just often a numbers game. And I'm sure I've written a blog post on this, but I think investors want to see they're ultimately taking a bet on the founder, and that, especially at the stage, that early stage companies are raising money, often without anything besides a pitch deck and a vision, which they plan to execute on. It's you're backing the founder's ability, their drive, their ambition, their commitment to build this vision. And so I think just being able to show that to people is crucial, and it doesn't often happen on a first call. But I think there's a famous blog post called by Mark Suster, which is "Invest in Lines, Not Dots," which is you want to see a little bit of a track record that someone is going to do what they say they're going to do over a period of time. And so one of the best tactical pieces of advice that I give to founders raising money is put everyone you've ever met in your life on an email list and just start sending updates on your business as if they are already investors in the company. Bring them along on the journey. And it just gives you the ability as a founder to control the narrative and show a line, a history, a track record of saying, hey, this is what we did last week. This is what we'll be doing over the next few weeks, and continue to update those investors over the course of, 4 weeks, 8 weeks, 2, 3, 6 months, however long it takes. Eventually these people will see, wow, Ben, Justin, they're going after this. This is a moving train. Whether we come on it or not, like, the company's pushing forward. There's nothing that's going to stop this founder from moving forward and building their business. And eventually, I think that becomes a great piece of collateral to then follow up directly with people. And I think follow up is key, right? If you're just someone who's relentless, who will not take, you could take no as an answer, but I think the key is you got to get an answer, right? Like, that was my job, and actually still is as a fund manager today, but certainly what I tell my founders is you need to get an answer, right? Like, don't take a ghost date, like, you just keep going. And I've seen time and time again founders that are just relentless with following up. And with each follow-up, you want to provide an update on the business, whether it's a new investor that came in, a new product that you've released, a new customer that you've gained, a new research on the industry as a whole and why the wind is shifting in the direction of the business that you're building. And so there's so many small little tactics and breadcrumbs that you can kind of leave behind. So you want to make sure you're pitching investors with capacity, right? I mean, you need to be speaking to someone who can actually has the dollars to give you. And then you just want to be consistent and continue to hit them. So it's no different than getting them as a customer, right? It's getting an investor. It's one of the same. It's sales, it's marketing. And so I think those are some of the ways that, founders can successfully raise capital.
On that point, though, you're a prominent angel investor and you probably get pitched all the time. Do founders do that enough? Like, that's interesting. Like breadcrumb, like, oh, this is a new update. Like they may have sent you something like 2 weeks ago where they sent you their pitch deck and their follow-up. Does it happen too often where founders follow up and they're like, hey, did you review the pitch deck? Instead of giving you a relevant update.
Hey, before we get to their answer, I want to take a quick second to just thank everybody that's been a part of the NYC round journey so far. If you've enjoyed these conversations we've been having with investors and founders, like, subscribe, and comment down below. Now back to the conversation.
It's a mixed bag. I get maybe 100 plus new pitches every week, and I would say that is one test that I do subtly with founders is just, I might say, hey, I'm underwater at the moment. This is interesting. Are you comfortable putting me on your updates so I can track in case things line up sort of at a later date? So I try and sort of give people a little bit of suggestion on how they can keep me engaged if it's not a fit right then and there. There's some companies that so sort of already love this category, been following them on social, and by the time we get on the phone, I'm already 80% there, and I'm kind of just validating other sort of information that I've already gathered. But then there's other companies that I've sort of passed on for a year, and because of their follow-ups and their investor updates, things just lined up where it made sense for me to jump on board. And I can give you tons of examples of that. I don't know if I want to be too specific.
Yeah.
But some people do it, some people don't. I try and give that advice. I think it's crucial. There's so much noise out there.
I'm sure there are first-time founders out there that don't do that enough.
Yeah. It's tough because there's only so much capital out there for, to invest in early stage companies. And, these founders, as I did, you kind of have to learn it the hard way. But I try and obviously, through mediums like this, along with, share practical advice on how you can get my attention and other people's attention.
That makes sense.
Yeah.
Cool. And then you write, so you sort of covered this earlier and alluded to it, but you write here, I was pitching as a solo non-technical founder, which presented significant risks given that we were ultimately building a software company. Do you think, a lot of low code tools today, no code tools, is this risk as prominent today? And what advice do you have for folks that find themselves in your position where they are a solo non-technical founder?
Yeah. First piece of advice, find a technical co-founder.
Yeah.
I mean, I'm sure we could find an example of a successful business that was building a software company without a technical founder. I think it would be, you're just making your life more difficult. I think it's almost a non-starter. If you're building a software business, you need someone who's extremely sophisticated and technically savvy to kind of be on the executive team as early as possible.
Yeah, that makes sense.
There's lots of resources to go out and find these people. That's just one of so many tasks that you'll need to accomplish, to be successful. So I think investors will want to see you come up to the table with a team that's that's ready and capable and somewhat experienced and can execute on the vision that has the proper incentives, right? Because a paid engineer is simply not going to have the same incentives as a founder with 10, 20, 50% ownership of the business.
Right. In the essay, you also talk about your first founder experience, your startup experience, pitching to keep the business alive. Tell us a little bit more about that experience and what did it teach you about the founders that you invest in or how you think about startups today?
It's a really tough situation because there's a famous quote that companies sort of die not when they run out of money, but when the founder runs out of energy. And I think in a lot of ways that's true, but in some cases you do need sort of the capital to execute certain things depending on the type of business. If things aren't moving in the direction that you sort of hoped, not most startups fail. And I think time is, our most limiting factor in life. And after a certain point, if you see the writing on the wall, the market's not ready, like there's enough signals that you collect where you think, okay, maybe it's now the time to kind of dissolve and shut the business and focus your time on something else.
Yeah.
And so, yeah, for me, I probably hung on maybe 6 months or a year too long, where I could have kind of winded down the business sooner. It's a very personal thing.
Yeah.
When you have your whole identity and your friends, your family, all this wrapped up in your big idea. But I think what founders often surprisingly realize is the people that either have invested in them or have watched and sort of supported and rooted them on will end up being completely understanding. And everyone sort of has failures in life. And so, again, it's just another lesson on the journey is, failure in a company does not mean you're a failure as a person.
Yeah.
Again, the most successful founders in the world could spend, a lifetime of showing you their failures before they hit their successful business. At a certain point, it makes sense to kind of close shop and spend your time on something that does have a more promising upside or outcome.
And then in the essay, for the folks that have either become angels or considering it, you write, I made a commitment to support these founders in any and every way possible to help turn their vision into reality. You spent countless hours making intros, hosting pitch events, copy editing emails, a lot of tactical things for these founders. So my question is, there are many angels that invest passively. What were activities that you felt, or still even today, you feel as an angel investor have an outsized impact on the founders that you're supporting?
Yeah, I answer this question a lot when I'm meeting a founder and they sort of give me their pitch. I'm always saying, hey, obviously what questions you have for me, happy to share my story, how I work with founders. And there's a few things here. So the first thing I would say to angel investors on how they can sort of be value add and move the needle. I think first and foremost, the most successful founders don't need the help of their investors. I think it's a mistake when investors say, I'm only going to invest in founders where I could be super value add. I think the key is having, sort of a competitive advantage in evaluating the business, right? So it makes sense. Investors want to invest in companies they have, insights into that maybe other people don't, again, have the ability to properly evaluate. But I think it's a mistake that a lot of angel investors make of, I only want to invest in founders that need my help, because the truth is the best founders, like I said, don't really need their investors' help. And sure, we can be helpful on the margins, but I think sort of acknowledging that if a founder is really needing the day-to-day help of their investor base, they might not actually be the best founder to actually invest in. All that being said, what I say to founders is a few things. So the first thing I say is, my goal is to be either your first or second favorite and most helpful investor. How do I do that? Let's start with the fact that I read. It seems wild, I know. But the truth is, most people don't. Whether they're VCs writing the lead check or other angels on the cap table, people are busy, focused on other things. Just the fact that I say to a founder, I will read your investor updates. I will be tracking you on social media. I will be reading your blog posts. If you're doing, the point is when we get on the phone, if we ever do, along the way of this 10-year journey, you're not going to need to explain to me, reiterate to me.
You're caught up.
I'm already, I know what's going on in your business. Let's get right to it. Let's basically use our time as a working session. So I'm tracking these businesses. That alone separates me from a lot of the other investors on the cap table. Is I'm up to speed. I'm paying attention. I'm watching. And so that's the first thing. The second thing is, don't be annoying. This is advice to other angel investors. The time, the way you do things, the time, sort of when you reach out, these are really crucial. Having the pulse of what's going on in the business and what's going on with the founder, I think is really crucial. The medium which you're communicating, right? There's some founders like email, some, you're DMing with, some you're texting with, some you're on the phone with. And so kind of working within what the founder is most comfortable with, I think is crucial. But I really say to founders, like, I'm going to take my cues from you.
Yeah.
What I look for is consistent written investor updates. Some founders are like, oh, I call all my investors, we speak. Written investor updates are crucial, right? It's really, it just enables the founder to kind of step back and kind of, take the time and thought to kind of put down what's going on in the business on paper. And then it's actually most efficient because it keeps everyone on the same page, right? If you're having a conversation with one investor, last week, and then someone else, like, we all have different information, and eventually it's kind of, there might be a point in time where we have to kind of make a decision. And if we're not all kind of,
Everyone's singing from the same music.
yeah, exactly. So, I really request and recommend really consistent, and I generally say quarterly updates because it's achievable. It's in line with, how public market companies report. I think monthly is a little bit burdensome. Obviously we want founders focused building their business, but so for my support, I really say put asks, pretty standard, put a section of asks in the investor update. And what I'll do, to me, this is table stakes. This is the baseline for me. I'm going to read your update and look to respond to these asks and just jump on any, ways that I can be helpful. So whether you're looking for other investors, customers, a new hire, I'm going to do my best to pick one ask at least from your update and try and move the ball forward in that case. And so, again, just sort of tracking where the business is, taking cues from the founder. And then I also have a newsletter that I send, often every Friday called like the Founder Friday feature. And so that's just like one way where I can put, send out a newsletter featuring my founder, featuring their company, sending that to 30,000 people, other VCs, other operators, throughout the ecosystem, and really just putting that business forward and shining the light on them, which will hopefully drive, whether it's other investors, other employees, you never know what can come. I think the key, everyone knows sort of attention is so valuable. And so any opportunity I can get to be promoting and championing my founders, I'm going to do it.
This is not a perfect illustration, but like if I think of like investing in a basket of stocks, I can choose from like ETFs, I can choose individual stocks, I can choose, bonds. So when you're a founder, you're looking at the different sources of potential investment. Based on things that you've said here in your experience, how should founders think about angels as a source of investment versus the other options they could go towards?
Yeah, I mean, I think oftentimes founders think, inexperienced founders think, oh, I'm starting a company, I'm going to go pitch all these VCs. And because sort of larger institutional funds are more than happy to take meetings. I mean, in fact, I actually learned sort of early in my own startup career, the bigger funds are mandated in their fund documents with their LPs. They need to take a certain number of meetings a given year. So I think a mistake first-time founders make is feeling like, oh, I have 10 meetings lined up. I'm good. I'm going to raise money from VCs when don't assume, or just because you had a nice meeting, that you're actually going to get a check. And I think that's a big misunderstanding and sort of false hope that VCs often give to early stage founders is, again, a meeting is nothing to celebrate. It's really not. Top funds and VC investors are required to take meetings with early stage companies. So I think a lot of founders end up kind of retracting and kind of backtracking and realizing, okay, I'm too early for VCs. Let me go to sort of the angel community, which can be a little bit harder to find these people because they might be lawyers and doctors and real estate investors or hedge fund managers. They're individuals who run a full-time job or have a full-time job and sort of angel investing as a hobby. And so people like me kind of play this unique role of, I'm not a part-time angel investor. I'm not a large institutional seed fund, but I'm like a professional angel and super connector.
Yeah.
And even, the name obviously of my fund, SuperAngel.Fund, which is, what I aspire to be, is really just an angel on steroids where I can write a small check and then introduce these founders to this, this sort of hidden network of angel investors who will write early checks based on founders and their vision in the market without yet seeing product traction revenue. And of course, we benefit from, often a better entry price and lower valuation for taking on that risk, but we have different standards than the institutional funds.
Got it. That makes sense. For folks that are entering angel investing, there's like David Rose's book on angel investing, but then there's Jason Calacanis's Angel.
Yeah.
What are your biggest takeaways from that book? Because it's one you talk about quite a bit.
Yeah, I think Jason is obviously widely known as being, an incredible super angel, if you will, and wrote a book called Angel, which a lot of people read early when they get into this business. And I think a few interesting takeaways are, with angel investing, one thing I love about it and kind of being a conduit for people through my fund and syndicate to sort of get exposure to these opportunities, it's hard to get rich renting your time, like if you're running a service business, versus owning a percentage equity of a business where, whether you're sleeping or not working, your dollars or your sweat equity, has this uncapped upside. So I think the asymmetric upside of angel investing is what I think Jason points out in his book. And one thing I love is we know what we can lose, right? Our downside is a known fixed amount. It's what we put into the company, whether it's, let's say, $10,000, $50,000, $100,000, we know what we can lose. It's defined. What isn't defined is the potential of what that investment can yield, whether it's 50x, 100x, 1,000 plus x. It creates a life-changing opportunity. And so I think that's just unique to investing in general, is that, and in angel investing in particular, in these seed stage companies, pre-seed stage companies, each check, whether it's 10,000 or even 5,000, does simply have the potential to become an Uber, for instance, in Jason's case, where it can turn into $100 million. And so I think that's just one general topic on angel investing and why I think it makes sense for everyone to kind of, test the waters and place a few bets. But I think another learning and what advice that I give to angels, which I think Jason, it's also in the book, I think you want to put fewer dollars into more companies, especially early, because the earlier stage that you invest in a company, the more risk. And every investment you make, you'll learn from, and you start to see patterns. And theoretically, you kind of get better and more comfortable and recognize patterns of what's working, what attributes of a founder lead to a successful, Series A investment and Series B investment. And so I think writing small checks into more companies, as opposed to, a lot of people learn about a startup and sure, like, maybe there's a very charismatic founder who presents an incredible vision, and, you don't really, you think, oh, this one's going to be it. And you put so many chips and dollars into one company, only to kind of learn later all of these mistakes.
Yeah.
And, you want to make your mistakes with smaller dollars. Smaller checks into more companies, I think, is a strategy.
And that experience.
Makes a lot of sense. And then, over time, you can kind of concentrate. And at least for me, like, I still execute that strategy today for my fund.
Yeah.
Is I like to write a small check as early as possible, and then really watch these founders and watch these companies and see who's outperforming even what they said their projections would be, and lean in and double down and triple down on the businesses that, have broken out. And again, one of the whole benefits to angel investing or just private company investing in general is, unlike public stocks where you're not allowed to clearly trade, you don't have access to private or inside information, and B, it's illegal to obviously do anything insider trading or make an investment based on non-public information. with private market investing, startups in particular, that's effectively the whole purpose. It's totally proprietary information. When a founder is telling me, hey, we just landed this customer, we're going to be expanding into, these stores, we have a new product that's going to 10x our business, we have a letter of intent from this person, or any number of sort of data points that would increase the value of the business. Sort of as an angel investor, you get access to that information, and oftentimes the price and valuation of the business doesn't kind of change, entirely in correlation to that upside. And so to be able to kind of make an investment based on private information is really unique and part of like what this industry sort of, how it works.
That makes sense. One of your most famous and successful investments was in Quip. Can you tell us the story of Quip, your involvement there, and what you learned from that process?
Sure, yeah. It was my first angel investment back in 2014. So I had just sort of come off my own startup experience. I was an early customer of Dollar Shave Club, which at the time, really innovative kind of business model, sort of subscription-based, D2C brand that was just adding, design and a great experience around an everyday item. And so sort of being a customer of this incredible brand, Dollar Shave Club, wasn't hard to see the potential for another category that was just as big in this toothbrush company, Quip. So yeah, I made a small investment really early, and the business just started to take off, and it just made me fall in love with angel investing, and I started investing in a lot of brands after that. So, started with $10,000 personal check in one company, and it grew to, basically investing in 30 brands over 6 years. I don't have any consumer background running an e-commerce business, but I'm, like everyone, a consumer, and, felt like I could identify a few different things.
You got it. Yeah.
Yeah. So
that makes sense.
Yeah, it was a cool one. Definitely started the ball rolling and got me, towards what I do today.
So you made some like pretty fun, really fun investments. I want to do a bit of a rapid fire for the first time founders in the audience who are pitching angel investments.
Sure.
I want to hear like in a sentence or two, like what was it that sold you on each of these? So Quip first.
Sure. Felt like multi-billion-dollar category, lacking innovation. Everyone brushes their teeth. Incredible founder who had all the expertise, industrial and product design background. So definitely felt like, team, market opportunity, that was ripe.
Makes sense. Party round.
Party round was really unique. Yeah, started I think sometime in 2021, and the just huge expansion of people making angel investments during the sort of low interest rate ZIRP era, and Party Round was making that more accessible for people, basically through just anyone being able to invest small dollars into a party round effectively. And great team building with great tailwinds. So that was
makes sense. Caraway,
incredible cookware brand, just creating a great product in a category, also ripe for disruption, high design innovation. Certainly top, 0.01% founder who had sort of experience in the industry before. A lot of competitors, but Caraway seems to have broken out with an incredible team that just knows how to execute in an enormous category.
Maybe two more. Olive.
Olive's a newer one. So everyone knows booking a room on a hotel website is incredibly difficult. Hotel websites are like brochures. They're not optimized for conversion like an e-commerce website is. So Olive is sort of like the Shopify for hotel websites, where they're just enabling hotels to keep more of their reservation and bookings as opposed to sort of paying a commission to Expedia or Booking.com. So another category. So great team. That's going to be consistent with every investment I make. It's the number one, attribute I look for. Great team of co-founders in a great space, bringing a lot of innovation.
That makes sense. And last one, provenance.
Sure. Another one that's all about the team. The founder, Steven, exceptional, incredibly talented, building a platform to kind of support wedding planning and actually funeral planning and sort of newborn birth planning stuff. But really, to me, what interests me is, the wedding category is enormous. And I'd kind of like to have a bet in every multi-billion-dollar category.
Yeah.
And certainly this was one where I feel like there's room for a new player, and there's so much commerce related to weddings with registries and all of the drama, and clearly the dollars that people go and that people spend in the category. So yeah, it's a cool one.
That makes sense. As an angel, you mentioned you read everything. So you look for pretty consistent updates on a quarterly basis. You look for an ask like section. What else do you ask of your founders as an angel investing in them?
I think this is crucial. I think a lot of investors have, sort of template questions. And I'm no different. I'm very thoughtful with everything that I ask for my founders. So one thing I like to know is kind of what motivates each founder and where does that motivation come from? Because I'm really trying to understand, is this someone who's willing to sacrifice everything in order to make their business successful? Because that's what it takes. I mean, it's just that hard. So really understanding if there's something in their, life that happened, do they have a chip on their shoulder? Where does that come from? Is it authentic? And so trying to understand their motivation that's driving them. And do they have, the attributes and the resiliency that you need to be successful? I love to ask, what is not going well when I meet a founder, right? Because I read their deck, I read their I'm being pitched. I understand all the good things and the potential of the business, but what right now is not going well, and kind of how are you handling that? So that's one other question. And then I want to understand, what obstacles or barriers do they see that could get in the way of the success of their business? And then also, alongside that, what does success look like to them? So I don't want to be the one to tell them this is going to be $1 billion, this has the potential to be $1 billion company, or it will be. I want to hear in their words what their goals are for success. Yeah. What does that look like? Because most startups fail. And so the ones that are successful, we really need founders to be shooting for the moon. So again, what obstacles or barriers do they foresee that could get in the way of sort of hindering their success? And then what does success look like? And then I love to read investor updates. Yeah. So before I invest in a company, if it's existed for a period of time before I'm getting involved, the best way to kind of get a sense of what to expect once you do become an investor moving forward is to see how have you been reporting in the past. So I think a lot of people don't do that. It's the best way to see the skeletons in the closet. There might have been co-founder changes before you got involved. How did the founder deal with it? How did they report? So that's crucial.
So you won't invest in a founder who doesn't give ongoing email updates.
I definitely, it's one data point. But so I won't say I won't, but I would say it's I'm collecting a series of data points, and that's one that I definitely give a lot of weight to. And then I do a lot of reference calls. So again, because for me, and just for context, so I've invested $20 million into a little over 100 companies on behalf of 500 LPs. Most of that being the last few years from SuperAngel.Fund and SuperAngel Syndicate. And it's just collecting all these patterns. So speaking to people who know the founder, have worked with the founder, have maybe invested in the founder, it's one of the best ways to get a sense of this person's character and capability, and have they sort of everything they said has taken place, or just sort of verifying information through references. I find that to be among the most powerful pieces of diligence that you can do.
Got it. This is my last question. It's NYC ground. Just your general thoughts on the New York City ecosystem today and where you think it's heading.
Yeah. So in my last quarterly update, I think I included a chart of how New York is absolutely second in line to San Francisco on most active ecosystem for venture, the dollars that are being invested here, the founders that are starting companies here. So I think it's sort of cemented itself as a for sure number two. Whether or not it becomes the number one, I don't think that's really that important. I think at the end of the day, it's a leader geographically speaking. Companies like Row and so many of my portfolio companies are based here. And so I think New York I'm very bullish. I was born here, lived here, continue to live here. And I think lots of upside the best days are ahead here in New York City. So yeah, founders can obviously reach out to me. I read every single pitch and email that I get. And so, yeah, opportunities like this are incredible to kind of, just spread my own marketing. And yeah, been a pleasure hanging out with you today.
Awesome. Thanks for coming on, Ben.